Welcome to the deep dive. Today we're tearing into the mechanics of one of the most extreme options trading strategies out there, the gamma blast.
Right.
And if you spend any time in trading circles, you've probably heard it called by its other name, zero hero.
And that name really says it all. We're focusing on this because the stakes are, oh, well, they're genuinely extreme. Most strategies talk about maybe doubling your capital.
Sure, 2x, 3x returns.
Exactly. But with the gamma blast, our sources are showing that it has the potential to magnify capital, 200, even 300 times over.
300 times. That's a number that sounds more like speculation than strategy.
It does. And that's where the zero hero nickname comes from, because the flip side is just as real. If your timing is off, even by a few minutes, that capital can go to zero instantly.
So the big question for today is whether this is just pure gambling or if there's actually a rules-based method here.
That's the core of it. Is there a way to capture this volatility with the system?
And we're talking about that wild phenomenon you see on expiry days, right? Usually late in the afternoon, after maybe 2:30 p.m., where these out-of-the-money options, the OTMs, are trading for just pennies, maybe a rupee.
Practically worthless.
And then suddenly they explode to 100, 200 rupees in minutes.
It looks like magic, but it's not. It's really just the physics of options trading. And to understand it, we have to start with the building blocks, the option Greeks, specifically delta and gamma.
Okay, let's lay that foundation. Option prices are always moving, and that movement is governed by these Greeks. Let's start with delta. It's probably the most important one for just understanding basic exposure.
Think of delta as the speedometer for your option. It tells you exactly how much your option's price, its premium, will change for every move in the underlying index.
So it dictates the speed of the price change?
Precisely.
Okay, so let's make that real for everyone listening. Let's say the Nifty is at, 20,000, and it jumps 100 points, and you have a call option that's priced at 50 rupees with a delta of, say, 0.5.
The math is simple. You just multiply the delta, which is 0.5, by the 100-point move in Nifty.
So that's 50.
50. So your option premium goes up by 50 rupees. It goes from 50 to 100. The delta is what controls that speed.
And key call options have a positive delta. They move with the market. But puts have a negative delta, right? Like minus 0.5.
Exactly. And that negative sign is crucial. It means when the market goes down, the put option's value goes up, its negative delta moves closer to zero, and that causes the premium to rise sharply.
Okay, that makes sense. But speed isn't constant in the market. It changes all the time. Which brings us to, I guess, the real star of today's deep dive, gamma.
Right.
If delta is the speedometer, then gamma has to be the accelerator.
That's the perfect analogy. Gamma measures how much the delta itself changes. It's the rate of change of the speed. So if the market moves up and you have positive gamma, your delta increases. Your option starts accelerating even faster.
And that's what causes those exponential price moves.
That's it. It's the acceleration.
Okay, now here's where it all connects back to the gamma blast. Our sources really stress this one point. Gamma is at its absolute highest when an option is at the money, ATM.
A peak. Yes.
And options that are way out of the money or deep in the money have almost no gamma, especially near expiry.
That ATM peak is everything. It's the whole puzzle.
That brings up a paradox, doesn't it? If these options we're watching, the ones trading for pennies, are deep OTM with almost zero gamma, why are they the ones that explode?
Because the explosion isn't caused by the state it's in. It's caused by the change of state. The gamma blast happens at the exact moment a worthless OTM option converts into an ATM option.
Okay, walk me through that. So Nifty is at 25,000. The 25,100 call option is OTM. Its gamma is basically flatlined. It's dead.
Right. But then let's say Nifty suddenly rallies 100 points and hits 25,100 on the dot. That 25,100 call is now instantly at the money. It is converted. And in that single moment, its gamma goes from near zero, from the flat part of the curve, straight to the absolute peak.
So the blast isn't from having high gamma. It's from the instantaneous spike in gamma from nothing to its maximum. That's the acceleration kicking in.
Exactly. It's an acceleration event, a conversion event. And now that we get the physics, let's look at the two actual models traders use to try and capture this.
Okay, let's start with model 1. This is the anticipated breakout. The sources are really clear that this is highly, highly risky. You're basically committing capital. You're okay with losing completely.
Yeah, and this model has very specific rules. First, the time. It has to be after 2:00 p.m. But more importantly, the second rule is that the market must have been flat all day. Like it shouldn't have moved more than 1% from the open.
So you need a coiled spring? a day with low volatility where energy is building up. And then the last rule is you enter on the nearest OTM option.
Right. And the whole game here is anticipation. Traders are watching the chart for signs that big institutions are about to make a move, that
Yeah.
they're accumulating positions.
You mean like spotting those stop-loss hunting wicks? The long shadows on the candles where the price dips just enough to trigger retail stops and then snaps right back up.
Precisely. That's a classic sign. It suggests big money is absorbing all the sell orders without letting the price really fall. They're getting ready for a push. You're betting that quiet period is about to end with a violent breakout.
But this feels like it's all about market timing. I mean, how do you know you're anticipating and not just hoping?
Well, that's the risk. But the discipline comes from the setup. You only take the trade if the market's been flat, that less than 1% rule, and you see those signs of accumulation. If the market's already in trending, the odds of a big explosive move are much lower.
Okay, so if you get it right, the breakout happens, your nearest OTM becomes ATM, and you get the gamma blast. What about the exit? What did Model 1 say?
The exit is just as important, and it's immediate. You sell the absolute second that auction converts to ATM.
Why so fast?
Because of the gamma curve. Remember, gamma peaks at the money. If you hold it any longer, as it goes in the money, gamma starts to drop off again. You lose that maximum acceleration you risked everything for.
It's really just about capturing that one fleeting moment of peak volatility. Okay, let's move to Model 2, the straddle chart breakout. This is framed as being comparatively safer, but it sounds way more complex.
It is more strategic, yeah. The rules start out pretty similar. The time is a little later, after 2:30 p.m., and you still need that tight, flat market that hasn't moved more than 1%. You need that coiled spring.
But the focus is totally different. We're not looking at the Nifty chart anymore. You're looking at something called the straddle chart of the ATM strike. What is a straddle
Like
chart?
just an average. It's the combined price of the at-the-money call and the at-the-money put. And normally, this chart just trends down all day.
Right, because of theta. Time decay is eating away at both options.
Exactly. So what this strategy looks for is a breakout against that natural downward trend. You're looking for a moment where sudden buying pressure is so strong it overwhelms the time decay and makes the combined value spike upwards.
And how do you know it's a real breakout and not just market noise?
You'd apply classic charting ideas like Dow theory. You're looking for a clear pattern of higher highs and higher lows on that straddle chart. That pattern is the trigger. It tells you a big volatility event is coming.
That's fascinating. So the straddle chart tells you a move is coming, but because it's both a call and a put, it doesn't tell you the direction of the move.
Right, so that's the final step. Once the straddle chart gives you the green light, you immediately switch back to the main spot chart, the Nifty itself, to see which way the price is actually breaking.
So if the straddle breaks out and the Nifty's pushing up, you buy the call. If Nifty's pushing down, you buy the put.
That's the whole process. Model 2 has a confirmation step that Model 1 doesn't, which is why it's considered a bit safer. But, and this is a big but, it's still an expiry day strategy. False breakouts happen. A failed trade is still 100% loss.
Okay, so to wrap this all up, we've broken down the gamma blast. We know delta is the speed, gamma is the acceleration. And the blast itself comes from that sudden conversion of a cheap out-of-the-money option into the high gamma at the money zone right before expiry.
Right. And the models are just two different ways of trying to time that conversion. One is pure anticipation. The other uses a confirmation trigger from a derivative chart.
And what's really crucial for you, the listener, to take away here is that these complex models exist for a reason. Capturing that tiny window of peak gamma is incredibly difficult, but also incredibly valuable.
It's an intellectual exercise in understanding market physics, whether you ever place a trade like this or not.
Which leaves us with a final thought for you to consider. Given that the success of this whole thing relies on catching a fleeting moment of peak volatility, how long can retail traders really play this game before big institutions and their high-frequency algorithms completely dominate this tiny window? The real edge might not be in trying to be faster, but in continuously learning the underlying mechanics, the delta and gamma behind these extreme market events. Keep studying the physics.